Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. It was a day of historic significance for India yesterday, and the entire country celebrated just as we celebrate a festival. Though earlier during the week we had some confusion regarding the market holiday declared on Monday, markets are fully functioning starting today. This week would be driven by multiple rate decisions, including the one from BOJ today. Good morning, JK. I'm sure you have lots to cover. Talk to us about events that will drive the markets this week.
Yeah, good morning, Swaraj. So the long break, from the market for Indian traders, while lots of things going on in the global market that requires, us to look at what's been really happening. Yields, which are the main drivers of all the markets and the dollar, they have remained more or less in a range, but at the higher end of the recent range. The pushback against market expectations by Fed members and strong job numbers, jobless claims last week coming at below 2 lakhs, and perhaps going to remain that way in the coming week. And also, some of the indicators remaining not so bad as expected has put more caution into traders expecting very deep cuts in interest rates as well as an early rate cut. So that's led to the yields remaining high, and also the fact that the Treasury has been issuing huge amount of new bonds. Yesterday there was as much as 67 billion of new bonds being issued for 2-year and 5-year tenors, and this is going to be more determinant of the yields rather than the economic numbers. So market is aware that in the previous quarter, Treasury had a quarterly deficit of over 500 billion, which means that they have to continue to borrow, and being an election year, spending will be more. And that leads to more issuances, and the yields cannot come down. So that's what is keeping the yields higher. Now look at the other market, the stock market. We have seen the S&P 500 make a new all-time high after 2 years of moving between highs and the lows, and this actually is seen by some people as a fresh bull market. The drivers of the market has been on the fresh bullish view on AI and technology stocks, and that is leading to all the three indices actually making headways in the US market. In fact, if you look at the last 4 sessions, Dow has gained 2.63%, to S&P 500 3.26%, and Nasdaq a whopping 5%. And the underlying support for the market is also the outlook on interest rates, where market still has a view of at least 4 cuts now, rather 5 cuts now. That's of course come down from the 6 cuts they were expecting, despite the fact that in March expectation of cut has come down to 40% probability rather than the 80% plus that was seen some time back. So markets are still rallying behind the fact that Fed will have to cut rates, and that is supporting the market, apart from the good prospects of the technology companies. So bond market on a range, and then stock markets are really doing well. Meanwhile, the economic indicators continue to be mixed in the major countries. In US yesterday, rather on Friday, we had the Michigan consumer sentiment, which actually soared once again, and inflation expectations came down for both the shorter and the longer tenor, which was good and supported the markets. But yesterday's leading economic indicators was in the negative territory for second month, and even the conference board was indicating that the US economy could be in a mild recession in Q2 and Q3 of 2024. And this again was a kind of sobering factor for the market. That's why yesterday the stocks came down. Rather, they did not close in the negative, but they actually gave up some of the initial gains and but still closed in good positive territory. Similar is the case with the UK, where we had mixed bag of indicators. Employment was weak, inflation came higher, and retail sales that came on Friday was much weaker. And the consumption, which is which it is also a good percentage of GDP in the UK, is something that worrying and could be indicator that even UK economy could be headed for a mild recession in the coming quarter. So we have a case building for the central banks to be on the dovish side, but I think they are really waiting for more evidence of inflation moving towards their target, and that's the reason why they are not committing to any early rate cuts. But at the same time, the two markets that remain in focus with contrasting reasons. And what is striking is the unabated rise in the Japanese market, gaining 13% so far in January. BOJ's continued dovish stand helping it. On the other side, we have a contrasting performance from Chinese market, which has fallen more than 8% in the same period, with investors clearly disappointed by authorities not taking any strong measures to support the economy or the market. So Japanese market continues to make new 4-decade high, while Chinese market is pushing towards the COVID lows. In fact, the extreme bearish sentiment in the market has pushed the Chinese premier to ask authorities to take more forceful measures to stabilize the slumping market and also to boost the investor sentiment. The Chinese situation is very precarious. Both the stocks and the currencies are falling, and the outflows on foreign exchange has been consistent. And I think it's a time for them to take some drastic decision, or some big decision of maybe large interest rate cuts, or even allowing the currency to fall to boost the export sector. Something like this is very much possible, and that is what the market is looking forward to. But they have been clearly disappointed by whatever that they have done so far. That's the reason why the market is still trading at the lows. As far as the Indian market is concerned, we have again slipped into a range between 83 and 83.20 now. Flows have been good on both sides. Good import buying closer to 83, and good selling from inflows, non-FII, of course, at or near 83.20. Very little intervention from central bank is heard so far, because market has been balancing itself. I think overall dollar cues for the rupee have not been very significant, because dollar index itself has been in a range. Now perhaps we are waiting for crucial central bank meetings. Today BOJ, tomorrow we have the ECB. Tomorrow we have the Canada meeting, Thursday the ECB, then we have February 1st, January 31st we have the FOMC meeting, and followed by the Bank of England meeting as well. So a lot of things to hear from the central bankers about when they are likely to change the interest rates. And also we have the core PCE number and the GDP number this week from US, which will be quite determinant of where the economy is headed, and as well as whether the inflation is falling further to change the Fed stance on monetary policy. So these factors are keeping the dollar range bound, and the same thing is also keeping the rupee on a rangish mode, while flows have been very flat this month, because there have been large outflows for equities, but inflows on bond market has really made it up. So I think going forward, bond inflows is what market is looking forward to. But I think we have a lot to digest before we see any particular trend in the dollar. Overall dollar upside correction seems to be not yet over, and that will keep also the USD and are generally trading above 83. Thank you.
Thank you, JK. And just quickly summarizing, yields have remained at the higher end of the range, and we are seeing some mixed bag of data when it comes to not just US but other major economies as well. Because in US we are seeing somewhat of a strong labor market data, which has been pushing against the rate cut expectations in March, which is, by the way, down to 40% from 80% at its peak. But markets continue to price approximately 5 cuts this year. Yesterday, we had $67 billion worth of new issuances by the US Treasury. That has kept the yields also elevated. S&P 500 has made a new all-time high after 2 years, and of course, the theme to follow is AI. When it comes to Indian markets, rupee slipped back into a narrow range of 83, between 83 and 83.20, awaiting further cues. We have a event-packed week this week with a lot of central banker meetings and data from the US. So do tune in constantly for the same. That's it from us today. Thanks for listening. Tune in tomorrow for the latest round for the latest updates in the financial markets.